You're turning 26? Wow, happy birthday! But wait, do you know what that means for your health insurance? Should you care what to do? Welcome. I am the medical bill whisperer, a previous billing manager turned patient advocate. I am committed to bringing answers, insights, and solutions to patients like you. So look at you all grown up. And I can assume that things like health insurance, premiums, claims have not been something of an issue for you until now. After all, you were probably covered under one of your parents' medical policy. And all was well until, well, I have to give you some bad news. Turning 26 is kind of the end of a good era. Yes, your parent will soon get a letter from the insurance company or the employer saying that, well, you're turning 26, so your policy will either be terminated at the end of this year or even at the end of the month of your birthday. So what to do? Panic? Well, remember, it's your birthday. You get one wish. So why not use it to get your own health coverage? The good thing is you are now eligible for what is called a qualifying event. It is a change in your personal or financial situation that enables you to apply for health insurance outside of a regular yearly enrollment period. So you can buy your own plan now on the open market, for example, through an insurance agent. You can also apply for a policy through the ACA/Obamacare marketplace. If you are employed and your company offers insurance, you can join that plan, or your spouse's if she is employed. Another option is to purchase a catastrophic plan. This is open to those under 30 who prefer to pay low monthly premiums, have a very high deductible because they would only use that plan for emergency conditions or circumstances. And the last option would be for you to claim COBRA status. In a nutshell, COBRA means that your parent's employer would extend the same coverage and policy to you, but under your own name for a time period between 18 to 36 months, as long as you pay the premiums. We'll get to that a little bit later. So one thing you can ask, if you are employed or if your spouse is employed and the company offers health insurance, can you join? Can you join your spouse's plan, and at what cost? Joining your company's plan, your spouse's plan, or buying your own plan are very good options. But if you are a student, you have access to student health insurance. Aetna and United Healthcare are the better carriers known for those plans, but each school has their own choice. I would suggest you contact administration to know more about what plan is offered at your school and how to enroll. As for COBRA, which I mentioned, it's that program that allows employees or their dependents to continue coverage with the same policy or similar policy as long as they pay the premiums. A special video can give you more details. You will pay 100% of the premiums, plus a small administrative fee. Yes, that could translate into higher monthly premiums than for a similar plan bought, let's say, on the marketplace. Another option, if you have low income or are medically needy, or even if your income is too high to qualify otherwise, but you are pregnant, disabled, or face high medical costs for medical expenses, consider applying for Medicaid. Medicaid is a federal and state program for those more disadvantaged, either medically or financially. Medicaid.gov or your state's Medicaid agency can help you figure out whether you qualify for this no-cost or very low-cost insurance plan. Now, it may seem like a very complicated process, so let me give you some tips. Like everything else in the adult world, planning ahead is a good thing. Consider your options, your budgets, your health status, your risk factors to help you make the best choice. Let's start with plans. There can be an HMO. This is a plan with a very restricted list of local network providers. You are assigned to a primary care physician who will refer you and authorize any and all medical services you may need. It is usually a cheaper option. A PPO is a little bit more expensive, but it comes with more freedom and access to care to a larger list of contracted providers. An EPO plan is kind of the same as a PPO, but with a very restricted network of providers and usually no benefit if you go outside of that network. And as far as catastrophic is concerned, well, if you are very healthy, never go to the doctor, and only would consider insurance for serious injuries, sicknesses, or emergencies, this may be an option for you. And then take your budget. A high deductible, low premium plan may be easy on your wallet. So if you do not go to the doctor often and are in overall very good health, this could be a very good option. The deductible is the amount that you must pay before your insurance makes any payment on healthcare services provided to you. You will end up paying the same for a low deductible, high premium plan than for a high deductible, low premium plan. However, again, if you don't use medical services, you will not have to deal with a deductible, and therefore low premiums could be at your advantage. Another thing is that some high deductible plans are what is called HSA or HRA compatible. It means that pre-tax contributions are made by either you or your employer to a special kind of savings accounts. Those funds can be used by you to pay off that high deductible or other medical, dental, or vision expenses. There are differences between both types of accounts. Basically, who makes the contributions? HSA would be you, pre-tax. HRA would be your employer. However, your HSA account would be yours to carry over from year to year and employer to employer, whereas an HRA account does not belong to you. If you don't use the funds, by the end of the year or by the time you quit the company, well, those funds would be lost. How is your health status? Are you under treatment now, or do you have a very healthy lifestyle? Do you get regular checkup? Do you take any type of medication? Do you have medical issues that require regular medical care? What about your family or personal health history? Do you have any planned medical services for the near future? All of these will impact your choice. Again, a high deductible, low monthly premium plan would be better if you do not use medical care often. On the contrary, if you need access to doctors often, a low deductible, high monthly premium plan may be better for your wallet. And don't forget, any risk factor, unhealthy habit, chronic condition, stressful lifestyle, the more or more serious risk factors you have, the more chances of you having to use the plan and therefore impacting whether a low deductible, high monthly premium might be better. When comparing plans, a couple of items come to mind. The first one is your total yearly share of cost. That is the premiums you will require to pay, the deductible, and the amount of a co-insurance. All of these are costs that you must pay first before the insurance pays 100%, versus the frequency of use. In the end, lower premiums plus higher share of cost equal lower share of cost and higher premiums for the same amount of use. But there are ways to reduce that share of cost. First, preventive care. If you only use your insurance to go get a checkup once a year, well, you can deduct that potential office visit copay from your total yearly share of cost because preventive care services are free. If your employer contributes to your HSA/HRA savings account, those funds can be used towards your deductible and your share of cost, and in some cases, to pay your premiums. So deduct those contributions from your yearly total liability as well. Another plus is because you are younger with less risk factors or anticipated need for medical care, the premiums overall are going to be cheaper. And remember, the marketplace plans offer subsidies to help with payment of premiums as well as savings that reduces your cost, which open market plans or employer-based plans usually do not. What to take into account in your yearly total share of cost would be any copay for prescription you are on. As for COBRA premiums, they likely will be higher than for a plan of similar benefits bought on the open market. But I will say, COBRA and its higher premiums might be worthwhile if you have already met your total yearly share of cost. Paying a higher premium for a few last months of the year could save you having to pay off a new deductible and new co-insurance amount. Now do stay timely. You only have 30 days from the last day of coverage under your parent to switch to your or your spouse's employer's plan. You do get 60 days to sign up for COBRA or to buy a plan through the marketplace. There will be tax consequences for you and for your parent. For example, if you decide to buy a plan on the marketplace, but you are still listed as a dependent under someone's tax return, you will not be eligible for subsidies or savings. As for contributions towards these HRA or HSA plans, the rules change on a yearly basis, as does the list of medical, dental, and vision expenses that are allowed by the IRS. Go down the list. You might be surprised as to what can be covered under an HSA/HRA savings plan. Last but not least, do reach out. There are people out there ready to help you to make the jump from being a dependent to being your own subscriber. School administrators will help guide you and enroll in the school's insurance plan. HR at your parents' business or at your own or your spouse's. Private insurance agents are there to help you, but especially marketplace navigators. They have been specially vetted and trained to help people find the best plans possible with the highest subsidies or lowest share of cost. So do use their services either by going to healthcare.gov or through your state's marketplace if they have one. Turning 26 can be a big deal, and yes, it can be a little bit scary. Growing up sometimes can be no fun, but there are solutions. So, a very, very happy birthday, and welcome to the world of being a subscriber and no longer a dependent. Thank you for watching. Your likes, comments, and subscribes help this little channel grow to reach out to more patients out there. So thank you.